Mark Matthew joins us. Let's say hello and good morning to Mark, and let's understand what he makes of the current market setup, both locally and globally. Mark, every time I look at India, I said, wow. But then I look at NASDAQ, I say, oh my God. But it does not stop there. If I look at gold and if I look at Bitcoin, I get speechless because that's where the real gains are.
Well, yes, it's true that 2024 is going down in history as a great year. And I don't think the bull market is over, but I do think that what has taken the market higher are the expectation of very high earnings growth and interest rate cuts. Now, with the interest rate cuts, if you look at the Fed funds futures, they're pricing in certainty of rate cuts in September, and then a high probability of rate cuts in November and December. So that's pretty much priced in. And the earnings, we have only kicked off the second quarter earnings season. They look very good. I think they'll probably come in at about 10%. And that's good because the consensus going into this second quarter earnings season was 8.5% for the S&P 500. But my point is, in a few weeks, that will be behind us too. And then what are the catalysts to look forward to after that? So obviously last night we had a pretty sizable sell-off in those technology stocks. And the question is how much of that was profit taking based on the explanation I just gave you, and how much was because of what Donald Trump said about Taiwan. I don't know the answer, but I'm not surprised we're seeing some profit taking now.
Mark, so what should one do in this market? If you sell, you regret. If you don't sell, there is law of gravity and fear of valuation. What is the best way to make maximum or maximize your gains in this kind of an market?
Well, I think the way to do it is by owning the entire market and not trying to pick sectors. And one of the reasons I say that is because right now there's an expectation Trump's going to be very tough on China, tough on lots of things. Well, leading up to his first year in office, 2015, on the campaign trail, he said that he was going to be very tough on the technology sector. He was going to break it in little pieces. Companies like Amazon. He was going to make companies like Apple manufacture their products in the United States. He was going to get rid of all the H-1B visas, which are so important for the technology sector. The best performing sector in his first year in office was the technology sector. Conversely, Biden was very negative on oil and gas. And he said that he was going to ban all exploration and production on federal land. He was going to ban all drilling offshore. And he was going to make the power sector in America emission-free by 2035. Lo and behold, the best performing sector in his first year in office was the oil and gas sector. So, trying to guess which sector is going to outperform, I think is a very tough thing. And it's better just to own the entire market. And there's still good reasons why stocks should go up, in my opinion.
Mark, hi, morning. The other thing is that India is in a sort of bubble of its own, and I better not say the word bubble just yet. But, just metaphorically, because, it's the local money which has actually pumped the stocks up, and, the global participation still is not as much in. What would it really take to get the FI money back meaningfully?
Well, I think what it might take is for the U.S. market to stop being such a great big bull market. And I don't mean to become a bear market. If it becomes a bear market, everything will go down. But instead of going like that, if the S&P just goes like that, then, of course, people start to look for alternatives elsewhere. And then they would immediately notice India because of all its attributes. is rightfully right at the top of the emerging markets totem pole. But with this huge bull market in the United States, there's just no need to diversify that much right now. And so until such stage, I suspect the FIIs won't be very present in the market.
Where do you think in next 1 year there is a likely potential of a double-digit return? In which is one asset class you think can give double-digit returns from here?
From here, I mean, I have a feeling that China could surprise us. I just mentioned before that Trump is being quite tough on China, but he never imposed sanctions the way the Biden administration did. He's all about trade, as you know. He's a businessman who wants to bring businessman sensibilities into the White House and the federal government. So he looks at foreign policy really through the prism of business and trade. And I think it's possible, but I don't know how probable, that in fact the ties between China and the US improve under him. And as I'm sure you're aware, China's been one of the worst markets in the world for the last 5 years. So it's certainly, if we're looking for value, it's right at the top. I mean, it's very cheap. So that could be a surprise. And I think you could easily see double digit in China in those circumstances.
Mark, the other thing people in India are also contemplating about, I mean, whether this is a typical bull market phenomena that you're seeing that sectoral churn, the beaten down FMCG, IT, etc. plays are making a comeback, or is there a meaningful trade, at least when it comes to FMCG, in the rural recovery, a big digress from the urbanization or premiumization which played out ever since the COVID lows?
I'm not in a position to answer that. I'm sorry, but allow me to simply say that it does seem intuitive in light of the surprisingly low turnout for the BJP in the rural areas of the North, that the government would be in a mood to try to help the rural economy more, and therefore that would benefit fast-moving consumer goods. I don't have much more to say about it than that. I'm sorry.
Mark, on a scale of 1 to 10, what are the chances that we could be in for no return or negative returns pretty much across the board? Now, whether it is gold, Bitcoin, whether it is bond, you know, if interest rates they go higher, bond investors don't make money. If interest rates they go higher, you know, nobody makes money. Similarly, if there's political uncertainty in the world, everybody will lose money. Are we in that phase where you need to be mindful of a 10-15% downside which could kick in anytime?
I think we could get a 10-15% drawdown. Why not? I mean, if you go back 40 years for the S&P 500, for example, the maximum peak to trough drawdown is 14%. On average, every year since 1980. So it's entirely normal, even in bull markets, that you get a correction of about 10 to 15% at some point during the year. Why not? But that's the nature of equities. They're volatile. I would say, that while it is possible, I don't think we're entering into a bear market. I don't see why we should, because the economy is strong, not just in the United States, but actually around the world. All of the big economies have purchasing managers indices that are above 50, which signal expansion. Interest rates are going to come down. If the Fed cuts, for sure, many others will follow. And Donald Trump, as much as he's a volatile personality, we know from his first term that the market likes him. Let's face it. From the day he took office until the pandemic hit, the S&P went up 55%, which I believe annualized is about 15%. So I see that we could easily get a pullback, profit taking in the order of 10-15%. But bear market, which means decline of 20% or more, I don't see the ingredients for that right now.
Really appreciate your time. So glad you could join us, and really look forward to much more of going forward.
If you like this video, then like, share and subscribe to ET Now.